All right, guys, welcome back to the channel. Today, I want to talk about small cap index funds and what I've been looking at and what I think is the best long term out of all of these. So, as you can see, I'm using the Fidelity website, and there's SPSM, VIOO, IJR, OVS, and SLYG. So, in this video, we're going to go through why I think SPSM is the best choice out of all of them. So, let's break it down. All right, guys. So the small cap ETF, all that means is that this investment is providing investment results that follow the return of the S&P 500 of 600 companies that are small capitalization of the US equity market. That's all it is. So this is riskier stocks, very volatile, and I only allocate 15% in my long-term portfolio to something like this. And in my, my other 401ks that I have, it's around like 10%. So, but I like this because it gives you a nice broad range and a different sector to invest in. So let me give you an example. So if you go under composition, which we can see, and we scroll down, you are going to see the market capitalization right here is small and micro. I like that because when you're investing in like the S&P 500, you're investing in large cap or giant. So large cap and giant for S&P 500 are not hitting this. So by investing in a smaller ETF, that's just the focused small and micro, you're hitting this and you're getting that coverage long term. And another way to look at it is just the style map. The S&P 500 would be around here on like blend or growth for large. But right here, this fund, SPSM, focuses just on the blend of small. So it's small cap, less than 10 million or whatever it is. So it's super low, which is good. Now let's break it down real quick. Let's look at SPSM. This is passively managed, so you don't have an active person. That's why the fees are so low at 0.03%. There's 611 companies. And what I like about this out of the other ones is the top 10 is only 5%. Normally when you trade like a large cap index like S&P 500, the top 10 companies that make it up will be like a 25-30%. But in this case, because the companies are so risky, you really have a small allocation. Like your largest allocation is in Cytokinetics at 0.71%, or Elf Beauty at 0.69%, or Fabrinet at 0.6%. So you get my drift. They're all pretty much, if this company goes out of business, Cytokinetics, it doesn't matter because it's such a low percentage. And that's what you want if you're going to invest over long term with this. So as you can see, it's all in the US, and you have a good broad range of these 600 companies with not taking up too much of the percentage, which is something I like. Now here's your sector exposure. So you're not just like in biotech. You're in financials, you're in industrials, you're in consumer discretionary, you're in technology, healthcare, real estate. So these are small companies in every single discipline. And that's what I like about it the most. You're not buying like a biotech ETF like XLB where it's strictly just biotechnology and it's super risky. You're getting all of the areas that you're investing in. Just what you're getting is smaller companies. So if you've been following my channel, you always know I tell you have to read the prospectus. Let's go through it. Let's just hit the highlights real quick. So this is the Spider portfolio, S&P 600 small cap. It's ticker symbol SPSM. It's an ETF. That's important to know. So let's look at the ETF. They always offer, valuable things because it's an index and it's passively managed. Your management fees are only 0.03%. That's huge. So this is a good example right here. The example is showing you if you invest $10,000 into this fund, in year one, you pay $3. So I can deal with that fee. And that $10,000 or in year three, that's it, $10 fee. Year 5, $17. Year 10, $39. So for me, this fund, I'm not worrying about the expense ratio. Totally fine. Now, the fund pays transaction costs, commissions when you buy and sell it over. So it has a higher portfolio turnover rate, which indicates a higher transaction cost. So it's just something to keep in mind. It's just giving you, what is the turnover rate, which is 22%. So people probably buy and sell this fund. But if I'm holding it long term, I only got to worry about this 0.03 expense ratio, which is something that I can live with. Now, what is the strategy of this? Like we said, it's just 600 small cap index fund, and all it's doing is that it is purchasing companies in the smaller sector. That's all it is. So here's a section that I want you to see because this is not a fund that I recommend putting like 90% of your money in. This is a 10% to 15% max allocation. Look what it says in the fine print: small capitalization securities risk. These small capitalization companies are more volatile and they involve more risk than the securities of larger companies such as like Tesla, Apple, etc. So you just have to keep in mind that it says, in addition, these companies may have recently organized and may have little or no track record of success. That's what you're investing in. You're investing in a high risk. If these companies get bigger and they're more successful, your fund's going to go up. So this is something that you have to be very weary of. And if you hold it long term, most likely it'll be fine, because we'll look at the chart later. But if you're holding this in the short term, you can have monster swings in your account. So it's definitely something to keep an eye on, and make sure that you are completely following and understand what you're buying with this ETF. I just want to illustrate the fund performance. So you can see right in here, 2014, 2015, you had 5% move, 4% downturn. And then look at that, 2016, 21% in 1 year, 15% in 2017, negative 11% in 2018, up 25% in 2019. 2020, 11% gain, and then 21 was big, 26% gain, and then 22, look at that, 16% drawback. So you were getting monster moves, so you can be going up or down, left and right. Something just to keep in mind how this can turn out for you. You have to be able to stomach this, and I think the only way to really do it is to dollar cost average. Just taking a quick snapshot of the distribution expenses, you're getting a yield of 1.61%. In my eyes, that's going to take care of your 0.03 expense ratio that you're paying. So for me, this is a no-brainer. I'm going to invest 10% of the portfolio into this dollar cost average. I'm not sure if I'm going to add it to the taxable portfolio because I already have this in my 401k. So I'm just trying to figure out where I'm going to allocate this, because I want to add more to small caps, because I think small caps are going to have a big year in 2024. So take a look at this. This is the life of the fund. It looks around 9%. Now remember, it's always against the benchmark, the S&P 500. This is why I always tell you, if you have a long-term portfolio, FXAIX and Fidelity is really king, because you got a 12% as your lifelong, but you're mixing it up with a small cap, getting a little extra exposure, and you're making 9%. There's nothing wrong with that. 9% is great. We aim for 7-8% long-term every year. Getting 9%. I think it's okay to cover the macro and the micro, and we don't know what's going to happen in the next few years. But it's definitely another way to allocate and diverse your portfolio, just to get a different share size. Everybody buys all these different index funds that have Microsoft, Apple, and Tesla just in different portfolio allocations. And for this, you're not going to be doubling up on anything, because this is all micro and small cap. So Fidelity has a great tool. Anytime you type in, like say, let's type in the ETF like I did, SPSM up here in the top left, you click on comparisons, and then you can start to see other funds that are offered that are similar. So let's just do a quick snapshot here. SPSM that I like is expense ratio 0.03%. I like that. It's lower than everybody else at 0.1, 0.06, 0.88, which is way too high. That one's already, OVS is, I don't even have to look at it, 0.88%. For small cap, why would you pay for that? And why is it higher? It's because it's actively managed. That's why. Look at SLYG is 0.15%. But I want to bring up IJR so you can combine, because they're very similar. But let's take a quick look at the composition of SPSM one more time just so you can see. And look at the ratio, 0.71, 0.69. Everything's under 0.71. So now let's go back to compare. And then let's click on IJR. So IJR is another one. That's a similar one, but you pay a 0.06% expense ratio. But as you can see, the top 10 was 4% in the other one, SPSM, whereas this top 10 is 7.2%. And that's just too high for me. And I'm not sure what this is. This 1.91% is cash funds. So I'm not exactly sure what that means. So for me, that was enough for me just to get rid of it. Because if I don't understand what is in the fund or where the money is getting allocated, I don't want my money to be part of it. But this is a very close second IJR. But let me just show you the comparison when it comes to like a higher actively managed fund. So let's go to OVS because it says actively managed. So when you go on OVS, you're paying more fees because this is actively managed. So this is completely in North America. And look at this, IJR. It has the money in IJR, which is passively managed. It's like, why would you ever buy this? It makes no sense. You're buying this just to pay higher expense ratios. It's just something to think about when you're looking at these expenses. So look at that, 0.88% for OVS. So I just want to bring up a fidelity definition that just helps you understand if you don't know what small cap means. Small cap just means it invests in companies with a market capitalization of 2 billion or less. So that's all those companies we looked at. When you look at mid cap, none of these funds that I showed you invest in mid cap. Mid cap means that the company has 2 billion to 10 billion in assets. So I just wanted to show you that big difference between the small cap, mid cap, and then the large cap just means that it's greater than 10 billion. That's all it is. So when you invest in these small caps, you're investing in any company that has $2 billion or less. So this is the chart on SPSM. Let's go on the max. I'm hitting max right now. And as you can see, it opened up around like $17. It went all the way up to about 22, pulled back to about 16. This is 2016. So this fund's only been out since like 2013. And now it's all the way up to $40. Right now, we are trading with, we were in this channel and we're starting to break out here, but you have a clear resistance point. If SPSM can get above $45, then it's off to the races. But right now, if you're going to dollar cost average into this thing, I would definitely be very weary. And I wouldn't be trying to buy at the $40 range, to be honest. I try to get around 38, start dollar cost averaging in, because look, you have the moving average right here, which allows you to, get a little bit better of a price target. But if you're just dollar cost averaging $100 a month or something, in my opinion, it doesn't really matter. But I'm always trying to get a better deal. But anywhere in this $33 range up to like 38 is where I'd be trying to make my entries. So I definitely think you still have time if you're looking to get into this fund. You don't have to, obviously. But it's been trading in this channel for the last almost 5 years. Look at 2019. This is the channel right here. Let me just see if I can draw it out for you, just if nobody sees it, just making sure. So look at this channel that it's been trading in. Here, all the way to about here. That's your channel. And now we're starting to potentially break out, but it looks like it rejected. So it's definitely something to keep an eye on. And right now, if SPSM, with the high interest rates and stuff like that, this is going to hurt companies like this with high interest rates right now. So we'll see how 2024 plays out with what Powell decides. But I think we have you could have a potential drawback to $35, $34, so 15%. And that's when I'd probably start really trying to go heavier in this fund. So there's still a good risk that you could just trade in this channel. And that's a good 15% drop from $40. All right, guys. So for my returning viewers, I appreciate you showing up to my videos, liking it, commenting, and subscribing. If you haven't seen it, Trading Simplified is my channel. That's my logo. And if you feel like you learned something, please hit that like, subscribe. And I really just bring up this fund because I think it's good to know that there's other things out there besides just buying large cap index fund, NASDAQ, S&P. It's good to buy other things long-term that are smaller or micro cap. Even if it's 5-7% of the portfolio, you have some exposure to it. So if you're holding it for 20 years, there's going to be a bull run and you're going to have the shares and you're going to ride that wave up. So it's definitely something to consider, and it's a nice long-term investment.